Good day, fellow deal makers. Welcome to the Deal Scout. On this episode, we have a returning champion who really opened our eyes and our minds about some of the investments of the world of cannabis. So we wanted to bring him back on, give us some updates, and he has a big announcement of some recent awards. So Rob, welcome back to the show.
Thanks a lot, Josh, for having us. It's a pleasure to be here.
Yeah. All right. So if someone wants to go back through the story, what we'll do is we'll put the other episode link in the show notes, but kind of give us an overview of who is Rob and what do you do?
Yeah, so I'm the co-founding president of Pelorus Equity Group, and we run the Pelorus Fund. We were the first dedicated lender to the cannabis sector in 2016. And today we've done about 71 transactions for over 450 million, with about half of those paying off. And we were the first private mortgage REIT in the sector, the first to get FDIC warehouse lines of credit, the first to become investment grade rated, the first to bring in institutional investors in an unsecured bond, the first for virtually everything except going public. And that was intentional. We didn't want to go public. We don't want to have any share price volatility. And we feel that this asset class is going to fare better in an economic downturn or real estate's down cycle. And so why would you want to put that volatility issue where it could be completely unrelated to the sector that we're in and not be able to continue driving through it?
Yeah, awesome. All right, so we're going to unpack public volatility in a few minutes, but that's huge for your industry to go institutional. Tell us, why is that such a great milestone to have an institutional investment based on what you guys do?
Sure. So we were not sure it was even possible. There is some rules and regulations of the Controlled Substance Act and some other things that really we weren't sure if it was going to be possible. So the first step was to get investment grade rated, and so we followed the path of IIPR, and IIPR was able to get a triple B plus, and we were able to get a triple B plus too. Now, remember, IIPR at the time was about $5 or $6 billion market cap, and we were 250 million at the time. So not only did we get the same investment grade rating as them, we were actually superior to them, but we were hard capped at triple B plus because we're in the cannabis sector. The next step was, once that happened, that opens you up to being able to bring on institutional investors, and those might be pension funds, insurance companies, banks, publicly traded banks, banks that are not in the cannabis sector, and to participate in that bond. And so we did an offering for 50 million at 7% coupon, but it's unsecured. And it's a really important distinction of being unsecured. So most lenders will go get a secured line of credit. And the difference there is that when you have a secured line of credit, there's always a look through to what is secured to establish the lending basis. So if you were in 2009 and you had a $100 million line of credit that was secured by $1 billion worth of real estate, and the real estate market completely tanked, and now they're calling your entire line of credit because nobody's making payments on your whole portfolio, that's a massive, massive problem. So when you do an unsecured bond, you only are guaranteeing you're going to make the payment. And so there is no look through to adjust the lending basis off that bond. And so it goes by the cash flows. And so we had some of the most superior cash flows that they had seen in the real estate sector. So, we theoretically should have been in the AA categories or much higher, but there's a hard cap at the triple B plus.
So when it comes to an investor taking a look at secured versus unsecured, like what are some of the questions that they have for you guys as they're looking at this process?
Yeah, it's interesting. Those investors have different questions than you would be if you were in our fund. And it was interesting. We had to switch our hats when we were talking to them. So basically, they're looking at more cash flows. They're looking at equity to debt ratios. How much secured debt are we carrying, and those types of things. And what are the covenants that are necessary that are going to be that bond is going to have. So some of the questions they wanted to know about legalization, they do have a lot of the same questions. They want to know about the history and what we've done. And we're the only lender in the country that is of our size and scale that's ever had a payoff. And so not only have we had a payoff, we've had more than anybody else out there. So they really wanted to know about that and see that and prove the strategy is working, and other various mechanical questions like that.
Copy that. So, before we go too far in this, like I want to, you guys have a recent like award that happened. You guys have gotten,
Well,
some milestones, right?
yeah, we've been nominated for the best lender as a finalist for the Benzinga Awards, which is coming up here next month in Chicago, or this month in Chicago. And so we're very grateful to be there with a couple of our two other lending peers, and we'll see what happens there. But we've been the lender to the sector since we were the first one that was a actual company that was dedicated and only doing this sector. We were the first to have a dedicated funding vehicle in 2018. So we've been here longer and have more data and more experience than anybody from a standpoint of transactional volume.
Got it. So you guys were the first to pave through a lot of stuff. Where has the industry, the cannabis industry, where has it changed the most if you looked back over the last 4 or 5 years or however long you've been doing this?
There's a couple of different aspects to that. I think that one is in investors' mindsets. So most of the time when people come in, because of the complexity, they come in on cannabis operator equity in the beginning. And so they're looking, they want to be a part of the industry. They want that 10x return. And so they're coming in on the equity. On the downside of that is that I think in a newly emerging industry that has regulatory reform still being developed and being issued in each state as it comes, it's a very risky speculative when you're on the equity side, because if you're ever betting on legislative reform, that is a bad bet to be on, in my opinion. And so, yeah, but the upside is that you theoretically should be in so low that when it does come to fruition, that you get that multiple X on that return. But the problem is that legislation is so complicated and it's never going the direction of why you think it's going there. So, cannabis reform and the States Act and all the numerous bills, it's not always the reason that you hear about why it's not going through. And in reality, we could talk about the politics in a little bit later, but we don't see there being any significant reform, certainly not any national legalization. And legalization is actually comprised of two things. Decriminalization is more for the individual and making it so that it's no longer illegal for a person, and the social equity aspect of that to make it retroactive to the people that are still in jail for it. And the other side is regulatory reform, where you have a national blueprint for all the states to operate under. And we just don't see that being possible at this point.
Sure.
You've got the horses out of the barn, and I just don't see that being the case.
Got it. So yeah, so if you're betting your investments on the future of a political reform, it could be a challenge. So what should or could investors be looking at, especially with the marketplace that we're in now, right? So, we're in a very unique time in our economy, as this recording in September of 2022.
Yeah.
What are your thoughts?
So normally when you're making equity investments, let's just primarily talk about stocks, you have metrics that of decades of data to look at and understand it. This is a brand new emerging industry. Every state is different, and every person is learning at a different place of their cycle of where they're at. And that is those normal ways that you would go about researching and going through stuff. And even the analysts that are researching us were like, these guys have no clue. They're conflating debt as unsecured, secured, construction loans, and all kinds of things together. We're like, nobody understands the space. So my first thing I would tell you is, I don't think anybody as an individual has enough insight to be a sophisticated investor in this sector. So now you're just kind of betting on what the flow is and what people are telling you. And I don't think that's a good spot to be in. I think that if you want to be in this sector, You want to be with somebody that has a lot of flows of transaction of real time and is staying in, that is an expert in it. Now, for example, an equity fund that has been in it for, there's many different ones of them out there, but those guys are experts and they understand the sector a lot better than you do. They know the nuances. I want somebody that's had some failures. That's where you learn. And it's just part of the process. And so a guy that's everything's gone perfect for him, there's that they have a bigger potential of losing big as opposed to the guy that had something go wrong in the beginning, but now he's at least prepared and de-risked for that.
Right.
So I would just say that I would stay to investors and funds where you have diversification of somebody that's intimately involved in the industry that has that insight. So that would be my first thing. And that it would be difficult because most of those funds are not publicly traded. Their entourage effect is one of them, and who we work with is one, for example. Or I would go to the other side of it and say, look, I'm not really willing to go into equity and have the ups and downs there. So the safe side to go to it is go on the debt side and go with one of the many different lenders. You could go private like us, or you could go public with two of our publicly traded mortgage REITs. They have a different lending strategy than us, but you still have somebody that's more of an expert and is seeing the actual underwriting, and they should be doing comparative analysis of other transactions they've seen like we do, so they know of the 2,000 deals we've looked at, we know what the market rate and costs should be relative to how many transactions we see. We've seen it more than anybody probably in the country and have a better idea of where those things should be. So that is something that you want to you're never going to have that look through. And so as a retail investor, you want to have somebody that's doing that for you and representing you.
Yeah. Awesome. Yeah, I appreciate you sharing that with us. When we take a look at, private versus public, right? Like, what are some of the differentiations? You said you guys chose strategically not to go the public route. Why? And then what makes you different?
Yeah. So first of all, being public is just a huge burden. You can't do things numerically fast. You've got a lot of regulatory. They typically want 4 or 5 more people just on accounting, and it's just this massive burden. It's usually $1 million a year of just extra cost to stay in compliance with that. But we would be willing to have done that. That could be handled in the size and scale of these companies and ourselves. But the more important part that we weren't willing to risk is that we think that there is a very strategic competitive advantage to being private, where you have no volatility of your share price. That gives a lot of people some really safeness of mind, that regardless of what the stock market is, my value basis of my investment is remaining the same. And that on the converse side, for our publicly traded peers, if they were to enter into a period where they're trading below their book value, they're not going to be able to issue any more equity. And so that would be a down round. And so you will run into a situation, and it happens sooner than we thought, that we're into a volatile market situation where that makes it so they may not be able to bring any more equity. And thus, depending on how long the market, those conditions last, they may not be able to lend for a while, or their hands are tied up significantly. So those are some big distinguishing differences. We also have a totally separate lending model than both of them, even though we're all three called mortgage REITs. They are more of a BDC or corporate debt lending model and utilize a different basis of lending as opposed to us. We just purely use the real estate cost basis. They use the real estate plus accounts receivable, enterprise value, and the value of the license. We believe that those metrics are too difficult to establish a basis on in an emerging industry that is non-profitable for most companies at this time. So we only stick to the asset base. So, we issue less proceeds than them. Borrowers are actually looking for most proceeds. So, they always talk to all three of us. And depending on where they're at in their life cycle, some are going to go that way and some are going to come this way.
Yeah. It's a new industry, right? And with it, you said go for the person who has broken through some challenges and had some failures, not some overnight success, not something that, no downside, but like go through people who have faced challenges and broke through. What kind of challenges or failures have you seen? Looking at 2,000 deals, invested in 71, like what are some of the things that you've seen firsthand?
Yeah. So, I mean, we've been through the market crash of 2009. We've had to foreclose on hundreds of properties. We've had to reposition all those properties. That's an enormous test of your ability to solve for things. We've also, with our cannabis sector of the business, we've also already had to foreclose on a property. And if you have not been able to show that you can successfully foreclose and recoup all your money, that's an unknown. And you certainly don't want to have to foreclose, but it's not necessarily a bad thing. Losing money is a bad thing. The reason that we foreclose is we have to be able to use that hammer because we have significant equity protection and we don't want to give up that equity. The only way to mitigate any loss is to keep that transaction where we have more equity than we have debt in that transaction. So some lenders are not even able to foreclose directly themselves, and that is a massive disadvantage to reducing your potential loss in a transaction. If you had to sell that note prior to it going to foreclosure, or if the borrower knew that you couldn't even file a foreclosure, that's a really important thing to know.
Is it because they're getting in at second or third positions, or why
It has
aren't
nothing
they?
to do with that.
Yeah.
To be uplisted on the NASDAQ, that's something you cannot have any direct involvement in owning real estate at any point whatsoever. That had to be cleared through NASDAQ.
Oh, no kidding. Okay, copy that. So as you're building this out, like you've looked at 2,000 deals and said yes to 71. That's a lot of deals you're looking at. What makes the perfect deal for you where you would say yes?
Yeah. So we're looking for, number one, the cannabis operator, which would be the tenant. We need to de-risk it first by them having experience. So we're looking for a successful operation, or at least the team has come from having successful operations. There's nobody in cannabis industry that hasn't had failure. Trust me. From crops failing, it's just part of the process. But we want to see somebody that's shown that they can actually make this happen and do it. So number one is experience. And number two is that we need a sponsor. We need somebody that has the personal net worth and balance sheet, him and or his company or the team of the sponsors, to have the liquidity, the cash flow, and the net worth to support the size of transactions that we're doing. And that is mission critical. The last part is that even with those first two, we still need the equity protection day one. So on our bridge lending program that we do, acquisition and build outs, that particular loan program, we will lend up to 100%. So we'll lend up to 60% of cost of what, and cost basis for us is the acquisition price, any tenant improvements or construction cost, and the equipment. So if it was 10 million for all of those things to be completed, we would lend up to 6 million. So you have to come in with 4 million day one. And so that equity protection is the final piece. And that's usually the hardest part to aggregate and put that together. And if it's not coming from the sponsors of the transaction, we track where that money comes from. And the people that are putting up the money have got to be the one that guarantees it.
So so this is awesome. I love this. So I'm a cannabis operator, tons of experience, and I'm looking to take down a $10 million property or a project, right? It's going to be a acquisition and build out. So I need to come up with $4 million in a sponsor. I don't have it. How do you, what are some of the ways that you've seen other people do that part well?
Yeah, well, there's different strategies of doing that. Generally, you can't get started without having some money or aggregating some money. So by the time that people get to us, they've already established some portion of investor base, either their own net worth and or their friends and family, and then they've usually hitched up with somebody else and built up some equity. So most of the time they're coming with some equity already there, or cash that they have. But to come up with the additional equity, the way that most people are going to do it is they're going to utilize the metrics from the transaction that we're closing, and they're going to go show that to their investors. Look, we're closed this $10 million project. It'll take us 18 months to fully stabilize it. And once it's fully stabilized, it's going to do $5 million a month. That $5 million a month is going to support the Nevada market. And so we're just taking and duplicating what we did in California over in this other state, and it's just a plug and play. So then they will show that to their investors, and it's much easier to raise the funds than to have to raise 100% of it out of pure equity. They say, look, we only need the 40% that is required, and you could look at the ROI on that and look at how that affects everything. Once you've run through that, you're always going to start with your first base. Once you've run through that, my suggestion would be to go to some of the better known funds out there, because you get more than just the money when you get it from them. You're getting best practices like we have of knowing what works and what doesn't work, and you're getting some information. There's some other value adds there. The only reason I mentioned Entourage is that we've known them for so long, and they've participated in a lot of equity and a lot of different transactions that we're in. But there's many different funds out there that do that. Another place that I tell people is, look, don't buy the property until you have to. So the first step you can do is go to the seller and make them your first investor, but you do it in this way. You just do an option to purchase. Make sure that you have that option to purchase recorded on the deed of trust so that they can't sell it without dealing with you. And what you're going to do is you've just eliminated having to put out the capital for the acquisition, so you can get the facility up and running as much as possible. We can't do that transaction because you don't own it yet, but we could go to the owner of the real estate and we could do the loan for him. He could increase the lease rate and build that in, so we could do it back in, wrap it around the back in a different way, and we would give the owner of the property the credit for the real estate when he purchased it, and some other metrics there. So there's just strategic ways to do it. If you don't have to spend the money, don't do it yet. It's the largest spend that you'll ever have to do. So let's push that off as far as possible. Try to work with the people that are involved in the transaction. The other way to do it with the seller is to do a seller financing. Mm-hmm. Just remember, the financing is enormously hard to find, and it's expensive. You could go to the seller and say, look, I'm willing to give you 15% interest only, for 2 years. And if the guy takes that, that's a reasonable rate. You've got it. Now you've got a path to go. Now it's just a matter of improving it somewhere down the line, but you've just solved for it. He probably is not going to require you to come in with 40%. He may only require 10%. So anytime you can solve something with debt, even if it's a really high rate, is way better than giving up equity, which is forever.
Yeah. Making that balance as a founder is extremely challenging, right? You have to look at so many different facets, and especially if you're challenged for capital today, right? And you're looking at these deals and you're like, man, I got to make this decision, debt or equity or these kind of things. I love creative finance. I love creative strategies to put deals together, and it sounds like you're really good at that. With the 71 deals that you guys have done, give us an idea on the range of size and what those kind of look like on average.
Sure. So because of the size and scale that we were at the beginning and the size and scale we are today, it's disproportionate to I'll just kind of give where it's at today. So today, our sweet spot is $20-30 million per transaction. Yeah. Our high water mark today is the $77 million transaction we did for the State House roll-up of Harborside, Urban Leaf, and one other brand. It'll come to me in a second. And the reason people are coming to us is that our ability to be innovative, and that transaction is a flagship of that. We had 3 separate borrower entities, 6 properties in multiple different counties that all had to have a loan closed prior to the roll-up. And the first $44 million went out in that part to each of them individual borrowers. And then it had to roll up as State House took them on board, they had to go into another loan and have the proceeds necessary from there. That's an extremely complicated transaction, and just saying it is one thing. To have the process to close it is where the metal meets the road, or the rubber meets the road. So that's extremely important. And I want to just take a step back for 1 second and also mention that not only can you talk to the sellers for the property and try to negotiate there with us, when we go to 60% loan to cost on a bridge loan, we might be willing to lean in up to another 5% and slightly reduce the equity that you're coming in with, and from future value of warrants. So you're actually selling warrants at a strike price that might be above what your trading price is today. So we do some creative things there if it warrants it.
Okay. So out of all the deals you did, right, taking a look at this, your largest deal to date, $77 million. What did you guys do to celebrate? Because that's a really big milestone.
That's funny. My partners and I have done so many deals in our life, and we kind of laugh at it that it's just one more deal behind us. We didn't do anything to celebrate it. It's just what we do. We did attend the State House celebrating closing party, and that was fun. And we did attend that. But for us, it's just showing up and doing what we do each day. There is not a big, even for that, it's just another deal to us. So I think that there's other things that are more. There's other things that we've achieved, getting the investment grade rating in the bond, that we celebrated because we know that changes the trajectory of the whole company.
And how did you celebrate that?
We didn't do anything crazy. It was just we actually spoke to, and we're on different offices. We have the New York office and people in Miami and Texas and here in California. So we didn't do anything crazy. We're just hey, this awesome.
Just good job, guys. Right. But yeah. As a deal guy, you've done a tremendous amount of deals in your life, right? Like you've been in the game for a while. You're a deal guy, right? So when you do a big deal, it's like, okay, on to the next one, right? What do you, as a very experienced deal guy, what do you look forward to, right? Like, is there a certain milestone or number?
Yeah.
Like, what are you excited about?
So, we want to. We're at about 314 million assets under management today. We want to be the first $1 billion fund, and so our fund has been sized for that. So we have the capacity to go to that, and we think that we're going to end around 400 to 500 million this year, and we think that we have a good shot of hitting $1 billion next year. So that's going to be a big accomplishment for us, and that we'll be high-fiving on. It's just, those are some milestones. Getting a fund to $1 billion is not an easy task, and you have to continue to switch strategies to get there. And with cannabis, those strategies don't even exist. They've all been brand new to get the first $250,000 or equity that we had, and the next 750 million is going to be different types of investors, different types of sizing. And so that we know, and we've got the path through, so we've mapped that out. So that's something that's really we're looking forward to, and we're enjoying what we're doing for the country, and we've lent on about 4.2 million square feet. We estimate that of the $50 billion real estate asset class that's just the real estate that we believe that we've probably built 10 to 15% of the entire U.S. market that is capital is flowing through and producing cannabis products. So we're proud of that, and I'm proud that I feel that at some point some people are going to use cannabis as an alternative to other drugs or alcohol, and I think that that's a benefit. And I pray that some people are using cannabis in lieu of opioids. Yeah. And that to me is a really important thing. And we don't have any metrics on that, but the country has such a massive opiate crisis. Anything that can change the trajectory is really important to us.
Yeah, I've interviewed probably 15, 20, cannabis investors or entrepreneurs, and that's something that it seems to be having a large impact in, putting a dent in that crisis, the opioid crisis, and what's going on in fentanyl and such. So like, super cool. When it comes to the plant, right, the cannabis industry, are there any types of, or are there any parts of the plant you guys don't touch, like as projects, or locations that you won't touch? Like, give us an
Yeah,
idea on what kind of deals you'll
sure.
do in the cannabis
So,
industry.
so we will work with any cannabis related business
Hmm.
in a commercial real estate that has commercial real estate.
Yeah.
We will not do any ag deals. So if it's an outdoor cultivation, that's a non-starter for us. And we won't do any hemp deals. It's just there's not enough scale there for us. So those are the carve outs. As far as geographic locations, we built our own database to know every single cannabis licensed operator in the United States and in Canada, even though we don't lend there, but we needed it for comparative, that market has been established longer. And so we need to know and track the market to know what's happening. That's how we know that this is about a $50 billion asset class. We need to be looking for where these licenses are situated, what types of licenses they have, who owns those licenses, have those facilities been built, has there been saturation in that particular state of more capacity than what the population, even if every single person smoked cannabis two pounds a day? Like, we needed to know those things. And so when we first entered the space, we were pretty sure, because there wasn't anything out there, that there wasn't enough scale to worry about it. But as we got more and more into it, we realized we need to know this information and track that stuff. So those were some really important things. And one other thing that back to the opioid crisis is that we were the first lender to lend to a DEA licensed federal facility.
Really?
And so there's a whole nother type of cannabis license class out there, and that is a federal license from the DEA. And what makes those unique is they cannot be in a state licensed facility. It has to be a separate facility, and they can't have any business together, no owners. And they are doing research for the federal government, because the federal government cannot deschedule or make any changes to the existing format that they have a stance on cannabis unless they can provide a study that is approved that shows there's a medical benefit. So those are happening right now. We're building one of those facilities. There's lots of those facilities licenses that are being issued across the country. And what's interesting about those licenses is that they can cross state lines and they can import and export, but it's only to other DEA licensed facilities for research. So it's still an enormous market.
Got it. So that seems like a great opportunity, right? Like, when you guys are looking at these kind of licenses, what kind of, what do you look for in those kind of deals where it could, you guys see the opportunity there?
Well, as a lender, we're mainly checking the boxes for the opportunity. When we see something that is truly amazing,
Yeah.
we want to try to get some equity. We're going to probably offer to increase our loan slightly to get some warrants there if we can. And on the really good opportunities, we may not get that the first time, but once they start working with us, there's usually an opportunity again later on in the life of that loan. So as they're expanding, as opposed to them going out to their equity investors, they could come to us and set a strike price on warrants that would be better than what they would have to sell their equity at today. And those warrants will be based on a future value.
Copy that. So if you guys come across a really sweet deal, you guys might do a little bit of both sides of the coin, right? The debt and the equity.
Yeah. Indirectly, yes. It's actually our borrower is typically the real estate owner, and the equity is on the tenant. So it's separate entities.
Super cool. Super cool. So as you're building this, Rob, like, you guys have hit some amazing milestones, on path to maybe hit $1 billion next year as a fund. What do you think is the future of your fund in the industry? Like, where's this heading?
So most people don't realize there's already about 120 lenders we're tracking in the space.
Oh, wow.
Several dozen of those are state, federal, and credit union banks. So not only is banking robust, 704, I think banks are listed on FinCET's website as depository banks, both federal and all across the board, but lending is robust across the country. It's everybody thinks that there's no banking and there's no lending. We've never, ever seen a transaction that the cannabis related business operator didn't have banking. That would be a massive red flag to us. Mm-hmm. And so that's a big disconnect there. And on the lending, what I try to tell people is no matter which way federal legislation goes, and we assume that all states will be medically licensed or medically approved within the next 5 years at most. And we assume that more and more lenders are going to continue to enter the space. They can. There's nothing that precludes them from doing it. But what we try to distinguish is that the value add lending, the building of the projects, nobody can compete with us there. We are one of the most sophisticated. We've done 5,000 of those transactions. We've competed against banks and other lenders that are private lenders as well, and we were best in class. So we're not worried there. And a lot of investors assume that if banking legislation or if federal legislation changes and opens up banking, they assume that that's going to impact the market, and that's a big misunderstanding. And the misunderstanding is that you have different class asset types of real estate. You have owner-occupied, residential owner-occupied. You have mixed use. You have investment properties. You have multifamily. You have commercial properties. But there's another type of property called specialty use, and cannabis is a specialty use property, and it's most similar to cold storage, data centers, or lab spaces. Those types of facilities require massive investment over and above what a typical property would be to have it built out for their specialty use, refrigerators, extra cooling, extra power, whatever it might be. And so when you get into specialty use properties, that's a specialized lender. And with cannabis, that is, you have different data points. So in cannabis, traditional lenders are going to use alternative value because it's federally illegal. Alternative value means what would this property do? What would it sell for or lease for if it was not cannabis related? And that's an important thing to know. But in what place do you utilize a different value for something that you're lending on than actually what it is? It's all actually against the real estate appraisal code. You've got to compare with like comps. But it's an important thing to know and analyze. But so you're always for traditional lenders, they're going to use alternative value, and typically the disparity is going to be about 40% on average. On alternative use is going to be at least 40% lower, and so but they also don't know to tie up additional collateral and how to make that property secured so that you have all the licenses in the event of a foreclosure. The banks don't know how to do that, and even if they did, they couldn't do it because of some challenges from their regulations. So they're never going to be a specialty use lender. But lastly, banks have concentration and geographic limits for borrowers or geographic. And in cannabis, just by the nature of the licensing, you're forced into zones of where the best tax bases are or where it's going to be. So even if the bank could do a loan, they can only do one or so there. And so they do another one somewhere else. And imagine if you were a specialty lender for wineries and you said, I've got to have even distribution around the country. But in reality, Napa is where probably 99% or 90% of the production for the entire country comes out of. And so would you set your concentration limits arbitrarily to only do 10% there? So you, as a specialty lender, you have to have other things that you look at. And that is going to preclude banks from ever being in the sector because they're going to have too high of concentration in certain geographic areas, which is where they're required to be. Got it.
As you are going through this process of building your fund, what does your day-to-day look like besides looking at 2,000 cannabis deals and studying legislation stuff?
Yeah, so we have about 15 people. 13 of those people are on the origination side of the company.
Oh, wow.
So that's not my side. My side and my team, actually it's 12 on that side. My team is 3, and we're working on the fund administration, strategic relationships, investor outreach campaigns, and the conferences, and all the things that is necessary for the investor relations. So my team manages making sure that the fund has the capital that it needs, and the other side makes sure that the capital has a home to go to.
Yeah. Excellent. During this interview, man, there's so many different topics we can discuss, but we're coming up on the end of the interview for today. What question or topic should I be asking you that maybe I didn't think about and I should have asked?
Well, a lot of people ask me what my outlook is on the political, what's happening, if I see any legislation reform. And my personal stance is I don't think that there's going to be any meaningful change in where things are at. And the choke point there is the Senate. And you need 60 votes to get through the Senate to be filibuster proof. And the disparity in the Senate is that the Democrats are more focused on social equity and the decriminalization of it. And the Republicans are more focused on the regulation side of it. And so the regulation side is more for the businesses and outlook going forward. And they're both very, very important. But the things that would fly through in 2 seconds, the repeal of 280E, the ability to process credit cards on the federal system, those would go through in 2 minutes or 2 seconds. But the Democrats aren't willing to let any legislation go through that they can't hang their decriminalization legislation on. So that disparity, I don't see the Democrats ever compromising on that. And the Republicans might be willing to do some, but it's never going to be enough to satisfy them. And so for the Democrats, they're going to continue to utilize this as a fundraising event. The Republicans probably as well, but in reality, both parties, this is a non-voter issue. Neither party is motivated to blow out any political capital because both of them support cannabis. And so there's never going to be a voter that switches his vote because one party is cannabis and one party is not. And so because of that being a non-party voting, non-voter issue, nobody's really going to drive, and it's relatively a small industry as far as the country is concerned. 25 billion maybe this year or something like that, maybe 45 billion in a couple of years. There's individual companies that do more than that. So it's not a big enough sector for a new administration that maybe has a 60 vote Senate majority and the House to push through legislation. They're not going to blow out the political capital on such a small industry. They're going to go for something much more broad that affects the entire country. That was a voter issue.
Yeah, that's super interesting. I've never looked at it that way, right? So if it's not going to get a new win, like they're not going to spend a lot of their social capital trying to push an agenda. So that means it's just going to kind of stay the way it is until something major happens.
Yeah.
Right?
And the way that I could see it happening fairly quickly is if you have a special interest group, big tech, big pharma, alcohol and tobacco, or somebody like Amazon that says, you're going to go this direction, or we're running somebody against you, and we're going to provide, $2 million or $5 million for somebody to run against the incumbent. Just say if it's a big enough company or a big enough party, that will move the needle. Because in the way politicians think is it doesn't matter what the benefit is to constituents, no matter what. That has nothing to do with what their votes are. The primary vote is to always remain in power. Because in their mind, the politician, I can't do any good unless I stay in power. So I always have to make sure I stay in power, no matter what it does to my constituents, so that I have a chance to be able to affect things for them in the future.
Yeah. So until Bezos wants to start slinging cannabis, we're probably not going to have any major reform.
They're big enough that they could say, we're going to run somebody against every single person, all 100 senators. And if you don't vote for this, we're running somebody against you. That would be meaningful. And that investment for them, if they were to be able to do delivery of cannabis, it would pay for it. That would be an investment that would make sense.
Yeah, awesome. So Rob, let's do this for fellow deal makers in the audience, especially people interested in learning more about the space, maybe investing in that kind of space, or maybe for some operators looking for some deals, right, and looking for some partners to help them take down some projects. Where could people go to connect with you and do a deal with you?
So for borrowers that are looking for loans, that would be email info, info at Pelorus Equity Group. And Pelorus Equity Group is Pelorus, and then the word equity and group spelled out.com. If it's related to on my side, my team, you would just email IR for investor relations at Pelorus Equity Group. And that goes to my whole team, and we'll provide you more information. And we're happy to answer questions and explain more of the nuance of it. We can't give investment advice on things, but we're happy to certainly give kind of our broad take on some of these things.
Super cool. I appreciate you coming back on, Rob. It's always a pleasure talking to you. Fellow deal makers in the audience, as always, reach out to our guests and say, thanks for coming on the show, educating us. Find a way to do a deal with our guest. And, if you have a deal that you'd like to talk about here on the show, The Deal Scout, head over to thedealscout.com, fill out a quick form, maybe get you on the show next. Till then, we'll talk to you all on the next episode. See you guys.